and welcome back. The April heat and humidity is absolutely sapping, but I always look forward to this part of the week where I'm sitting and making sense of some of the personal finance news headlines from the previous week to ensure that some of those vague headlines or ones that need to be broken into can be made sense of for your money life. Okay, so let's begin. The first one is around the LIC IPO. The LIC IPO, it says in LIC IPO in early May, conditions apply. What this means is that every IPO that's approved by SEBI has a timeline within which the company needs to sort of launch the public issue. LIC's timeline probably runs out in May. What this means is that if they don't offer the issue for public subscription by May, then they'll have to wait longer and include FY23 financials. The markets have been uncertain. Perhaps that's why the LIC IPO, which was expected in March, hasn't come out yet. But let's see. Yeah, I mean, it'll be disappointing for those of you who are waiting. And also, the more the wait time increases, the more the issue price needs to be reevaluated given fresh information and fresh business that happens in that period of time as well. Okay, so the next thing. Fixed income investors can earn 6.75 to 10.4% on these NCDs. And there are 5 NCDs that are mentioned in this article. Yes, the interest rates probably look attractive because they're higher than your fixed deposit, bank fixed deposit rates. But keep in mind, these are not bank fixed deposits. These are corporate non-convertible debentures. They are secured. However, there is risk involved. Which means that the debenture issuer, the company, could default and you may not get your money back. So check the credit quality and do your research on the company before investing in these. Secondly, there is tax on the interest income that you receive. So it's not like you will be receiving, a 10% return. 10% is pre-tax. You have to add the tax liability according to your income tax rate on that and then see how much you're getting net of tax. And thirdly, remember, if you are going to invest a lot of money in one NCD, you do suffer the risk of concentration as well. Unlike debt funds, which invest in several instruments of debt from different companies, and it's a diversified portfolio, investing a large chunk in one NCD can, have that additional risk that if something goes wrong, you lose a large chunk of your money. So be careful about NCDs. There is risk. It's not like you're getting a high return just for nothing. Yeah. Okay. Use UPI for investing up to 5 lakhs in public issues. Now that's really good news. We are using UPI till now for making small payments here and there. If you're calling for things, then you pay through UPI, or if you're transferring money to a friend or somebody, then you pay through UPI. But now they're saying that SEBI will enable individual investors to invest up to 5 lakh rupees in an IPO through UPI. Now that's good news, obviously, because digital makes our life easier. However, it is not a sanction that you must invest 5 lakhs in every IPO. IPO investing needs to be done extremely carefully and only if you have large surpluses that you can spare for multiple IPOs. Oh, this is the big news of the week, which is the merger of HDFC Limited and HDFC Bank. Now, this was in fray for a long time. So people have been expecting this. It's just that people didn't expect it now. However, for various reasons, the time seems to be more opportune now. What it means for you, if you're a shareholder, for every, I think, HDFC shareholder, the final entity will be HDFC Bank. HDFC shareholders will receive 42 shares of HDFC Bank for every 25 shares they hold. There is a lot expected from this merger. HDFC Bank is already the largest private sector bank by market capitalization. So, a lot can happen. A lot can also go wrong. The merged entity will require 2 to 3 years to comply with all the regulatory requirements. And of course, what their business strategy is going to be from here on, one needs to wait and watch. But it's a lot of exciting activity for not just the shareholders, but also HDFC Bank customers. And I'm one of them, and I'm eager to see what's in store for me once this merger is complete. Okay, what's next? FMCG CEOs see inflation eating into volumes. I know you're hearing inflation week after week and you might be bored of it, but don't be. What this means, FMCG CEOs see inflation eating into volumes, means they expect the sales volumes to go down. Sales volumes can go down typically if prices go up and people are unwilling to pay those prices, and prices will go up of end products if raw material prices go up. Raw material prices will go up if inflation hits those prices. Then that translates to end product prices and inflation hit your pocket. And that's what we've been talking about, inflation hitting your pocket. So this is another confirmation from FMCG CEOs that you're looking at higher prices for your groceries. Okay, on the flip side, home prices increase across key markets as demand improves. So there are several reports which are indicating that residential house prices are back on an uptrend after 7 to 8 years of, stagnation or even prices going down in micro markets. And now reports suggest that this trend is going to turn with prices going up. This headline in no way is suggestive that it's the right time for you to buy or the right time for you to sell your house. Those decisions are dependent on your particular situation. So don't get swayed. It's a good time to buy a house if you have enough money saved up to own substantial equity in the house rather than going in for a 80-90% loan. Now that really doesn't depend on the market condition, that depends on your financial condition. So be a little circumspect of these kind of headlines and don't take them into your personal money life just as the way you read them here. Okay, this is an interesting thing that I came across, and I think one needs to be wary of this, especially if you are relying on your credit card to give you discounts and vouchers and help you in your budgeting. SBI Cards warns about Big Bazaar vouchers. What's happened with Big Bazaar is that it's run into legal trouble with Amazon. The Future Group has, and Big Bazaar is part of that. And overnight, there's been a Reliance takeover, and there's a lot of confusion within the corporates. Now, SBI has a joint or a co-branded card with Fashion at Big Bazaar, which gives out vouchers depending on how much you have spent on the card. But now SBI is saying that, look, I don't think we can, we can redeem those vouchers for you because of all this legal confusion that's happening. So would you lose out? Maybe. It's still not clear what direction it's headed. I don't think even SBI is clear. But yeah, I mean, these are signs which you have to look out for if you rely on such vouchers to help you manage your budget. Okay, I think that's about it. So those were some of the main headlines that I wanted to speak about. Hope that helps you clarify some of your doubts. Do keep listening into News You Can Use. See you next week.